Hey folks, it's Dave Burrows. I am Chief Investment Officer and CEO here at Barometer Capital Management. I want to thank everybody for tuning in. I know we have lots of clients on today and some friends of the firm who are interested in sort of keeping up on what's going on market-wise. As always, I want to take kind of a top-down view of what's going on in the market. Take a look at changes that have been taking place over the last 3, 4, or 5 weeks. Talk about how that impacts what we're doing in portfolios, and some of the things that we're watching as things are developing. Of course, the beginning of a new year, it's always interesting to see, what, if anything, is changing. I think everybody does a little bit of navel gazing to figure out what they should be worried about over the course of the year, and what things might generate some returns. Our job isn't to be everywhere. The portfolios we run are really aimed at trying to identify and take advantage of big structural changes that are taking place, where the securities that provide services or products into those areas really benefit and where they can get a really significant lift. So it's about finding productive assets. So as always, I just want to start with a top-down view of the world. We believe we've been in a bull market in stocks globally for quite some time, started in 2013 in the US, and has spread to other parts of the world. If I look at the S&P 500 since 2013, we've had several corrections along the way, as is quite normal, as we did between 1981 and 1999. And the most recent one was December of 2021 through January of 2023. So we've been rising since the lows in October of 22. And so far on the year, market's down about 1%. In the month of December, market was off about 1.6%. So not a surprise to see the market pull in a little bit. It happens. But we are well above this rising 200-week moving average, which tends to be the lower bound in a bull market. And 2 years into this bull market that started at the lows, we know that on average, if the market gets 2 years under its belt, ultimately a bull cycle might last 5 years without significant interruptions. So we do think markets can correct in the short run. They don't tend to have a large correction at this point. When we look at the S&P under a microscope, you can see that we've had this series of higher highs and higher lows. And right now we've pulled back from the highs in the early part of December. 1, 2, 3 legs. We're trading below the 50-day moving average. So that's something that we want to keep an eye on. We're well above the 200-day moving average. And we've come out of this channel the market was in really since July. So this marks some correction. And we know things don't go straight higher. If we look at the NASDAQ 100, the big 100 tech stocks in the US, communications and technology, same kind of thing. It came down out of this channel. The tech sector in general had underperformed a little bit from July on, and it's an area that we've been underweight and discussing along the way. But these are things that we keep an eye on. So market is correcting. And when the market corrects, we have a game plan. I think it's really important to have rules when it comes to decision making in the market, to take emotion out of the equation. So we talk a little bit about that today. And as a result, we're sitting with a little bit of cash that we've had since December, and we're not doing a lot and putting money to work. But what I want to do is just kind of walk through some of our key thoughts. Now, we have highlighted that US equities have done remarkably well over the last decade relative to the rest of the world. And a year ago, we started talking about moving some money out of the US into global markets outside of North America, and frankly, some of it into Canada, in some sectors that had not been great performers for many years, but were very, very inexpensive. Japan is one of those markets, and it continues to look quite favorable. A couple of South American countries have been going through changes, and they're behaving quite well. But this is not all about being in the US. If you look at the MSCI All World Index, over 70% of the weight in the index is US companies because they've done so remarkably well. And to be clear, there are some wonderful companies, world-beating companies, and we've been participating. Having said that, the difference in valuation in the price earnings multiple, or the average multiple you're paying for earnings in the S&P 500 is 22.5 times versus about 13 times earnings in the MSCI All World Index. And last year, that global fund that we started a year ago to try and take advantage of that was up 27%. It's had a great return. And we think that there's lots of opportunity going forward. But whether we're looking at the US or Canada or other global markets, our key belief is that equities are in a long-term bull market. And that if inflation is an issue, and we believe that it is, companies have the ability to raise price. And so we learn that over a long period of time, one of the ways you hedge against inflation is you own companies that have pricing power. And we think that there are several companies in several sectors globally, that really look attractive. The TSX, similar to the rest of the world, actually came out of a long period of underperformance, 2007, through 2024. And we saw that the Canadian market start to march its way higher. And again, like the US market, has corrected a little bit since the beginning of December. Now, in the middle of December, we highlighted that some parts of the market globally had shown some deterioration in breadth, or the percentage of stocks in some geographic regions were showing a little bit of sloppiness, and that we were watching it. So the average country, if we put them on a distribution curve, putting countries with the highest percentage of stocks performing well at this end and countries with the smallest percentage of stocks doing well at this end, the average country had 44% of stocks in uptrends. As a reminder, we like to own markets and sectors and themes where over time, a higher and higher percent of stocks are performing well or participating in strength. Expanding breadth is healthy in a market. So this was as of a week ago. And if we look at it today, over the last month, the average country has had 7% of stocks break down on their charts. So the average country has 37% of stocks performing well. As of a month ago, it was at 44%. So you can see more pink on the screen, more countries that are seeing some deterioration, which of course makes us a little bit more cautious. But we'll talk about that as we go along. We look at the bond market. The bond market's been in a bear market. As opposed to rates falling from 1981 to 2020, they've been rising over the last 4 years. The last time we started a significant move like this was in the late 1940s, early 1950s. And we know that when rates start going higher for a long-term structural move, it can last for 20, 30 years at a time. And as we saw in the early 1950s, rates went up for the next 30 years. Rates then fell from 1981 to 2020, 40 years. And they've been rising over the last 4. We think this is the beginning of something bigger. And that really gives us pause, because what works during a long period of falling interest rates, like say real estate, is different than what works in a long period of rising rates or inflation. So as rates fell through 1980 to 2020, companies that borrowed money had an advantage because their cost of capital kept going down. Companies that consume capital today have a problem because the cost of capital is going higher. So important to find companies that are generators of cash, not consumers of cash. And that has been the case since 2020. We think that we are in a period of rising rates, and that's not going to change anytime soon, even though the Bank of Canada and the Federal Reserve in the US and other central banks in the world are cutting rates on the short-term rates. Bond yields are going higher. If you look at a 20 or 30-year US Treasury bond, they've been falling in price since March of 2020, and we basically are around the lows. So a 30-year bond is down about 50% in value, even though it's paid its coupon all the way along. the bond market is in a bear market. It's the longest bear market in 45 years. And this is an area that we have been avoiding. The major reason we've been avoiding it is despite the fact that inflation in blue has started coming down, historically, when you got a big rise in inflation after a period of resting, you got a second rise. And that's something that we're watching. Now, in November, when we got the CPI data, we saw that it started to tick a little higher. Historically speaking, if you take all of the previous periods of inflation, after a period of time, you started to get a move higher. We got a move higher in November. We're about to get the CPI data for December this week, and we'll see what comes out. But I think the bond market is somewhat concerned. So in our income mandate, we have to pick our spots. Our income mandate is aimed at generating total return. So an income stream plus some appreciation in value. We can be in any kind of cash flow generating asset, anything from treasury bills at one end of the spectrum to dividend paying common shares and dividend growth stocks, but we could own investment grade bonds, we could own government bonds, we can own preferred shares. The goal is to build a basket of securities that are going to generate income and are the right type of securities for the environment that we're in. Some things that stand out to us. Since 2020, if you were going to be in bonds, high yield bonds have been outperforming the broad bond index. Well, that's important. This is a market signal. When high yield bonds, otherwise known as junk, higher risk bonds are outperforming, it tends to be in a period where investors are comfortable and confident in the economy. And you can see that high yield bonds have recently traded to new highs relative to the rest of the bond market. That's a signal that should tell you you should not be overly concerned of recession in the near term. The bond market is not concerned about the highest risk part of the bond market. If they were concerned about recession, you would expect high yield bonds to be underperforming aggregate bonds. So where we've looked at bonds over the last couple of years, and we have a couple of mandates that have to own some bonds, it's been corporate bonds that we've owned of short maturities because we think the rates are going higher. If we compare stocks versus bonds as an asset class, stocks are clearly outperforming relative to bonds. So we lean towards equities across all of our mandates. If we look at income securities, dividend growth stocks are clearly outperforming bonds. So dividend growth is the camp that we've focused in over the last 3 years, where the aggregate bond index last year in the US was up a little over 1%. The income mandate was up a little over 20, and that's because it was focused in dividend growth. If we compare dividend growth securities as measured by the RDVY ETF, that's a basket of dividend growing companies, to a basket of high dividend payers. High dividend payers tend to pay a higher dividend but have less dividend growth. Again, dividend growth leading. So we look at these every week to say, is something changing? And clearly dividend growth continues to be a very strong performer, outperforming all of these other cohorts. Nothing changing here. So the tactical income mandate, I think we get our December number shortly. Since inception in 2000, that's 24 years, just over 10% a year relative to a basket of 50% bonds and 50% dividend growing companies. Moving on. The commodities index. Now, I've been watching this closely since 2020 because we started to see a significant shift. After a long period of underperformance, commodity prices started to rise. Well, that was coincident with the increase in inflation. And during the global central bank tightening period, where rates went higher, commodities didn't really come off the boil, they moved sideways. That's a first clue that maybe inflation is more persistent than what policymakers would like to see. And over the last number of months, commodity prices as a whole started to do a little better. Now, some commodities better, some commodities worse. But look at this over the last 5 months, this basket rising after a period of consolidation. So we think we're in the next leg up. And similarly, when commodities get going or they start to underperform, it goes on for a long time. They underperformed from 2011 to 2020, and now we're going the other way. So what do I take away from this? If commodity prices are performing well, which tend to do well in an inflationary environment, and bonds are performing poorly and basically near lows, the market is not anticipating a significant reduction in inflation. The market, investors are positioning in assets that benefit in a more inflationary environment. So when I look at something like gold, which was about the best performing asset in the world last year, it continues to look very, very good. If you look over the last 13 years, you had a long bear market and you started a new bull market. To put it in perspective, the last bear market that then turned into a bull market lasted 25 years. So gold rallied from 2006 until 2012, very significant bull market. If we look at the period so far, you've had the bear market, you began a bull market, but gold is up 33% since the bull market began. The last bull market was 345%, 10 times the return so far that we've seen in gold. So we think that's relatively early days, but that also goes along hand in glove with the idea that inflation probably is something we should be thinking about. The length of this bull market is relatively short relative to other historical gold bull markets. Other commodities, oil. Now, oil corrected through 2024, and energy stocks did as well. But recently, we've seen a turn, and on the point and figure chart, oil started to lift. So if we compare commodities to bonds, commodities are the outperforming asset, making new highs. If we compare commodities relative to the equally weighted S&P, in fact, since 2020, commodities have outperformed. But recently, over the last year, you saw some consolidation. So that's something to watch to see if that starts to pick up again. Gold versus the bond market. Well, clearly, investors are hedging for inflation as opposed to hedging for deflation, which you would do by buying bonds. And then when we look at Bitcoin relative to the equally weighted S&P is outperforming. Something just to keep in mind. It's not for everybody. We've used it inside our macro portfolio, and we are learning. But Bitcoin apparently is an inflation-resistant asset. So Bitcoin relative to aggregate bond index is performing well. So if I had to put things in order of expression, equities would be the number one performing asset, followed in behind by commodities, followed in behind by cash, followed in behind by international stocks, followed in behind by fixed income. Okay, so moving on. We don't have to be everywhere. Our job is to really try to identify market leadership, the things that benefit in the current environment. We're always looking for recognized change, and we're going to talk a little bit about that today. And in the absence of leadership, or where things correct, our job is to play defense. Number one job is not to give back too much when things correct. So it's a tactical approach we're trying to deploy. We're not invested all the time. We don't own every part of the market. Our job is to own productive assets. When we think about it, in a constructive market over time, a higher and higher percentage of stocks should perform well. When you get to a late stage of a bear market, there will be a few securities that turn up first. So when we're going through a correction, we're looking to see what is it that holds up better than other things. And then when we see some strength, what is it that lifts and start to make new highs first? What is it that moves into an uptrend before the rest of the market? So the days like today, while we're not buying things, we're watching closely to see what is it that's bucking the trend. In a healthy market over time, more and more stocks should participate in strength. So in our work, we believe that 80% of return comes from getting to the right neighborhood, parts of the market that are seeing net expanding breadth. Okay, and so of all of the groups that we can be in, we're trying to identify those groups that are timely now. Now, the second part of the exercise is to try to find specific securities, stocks or bonds or ETFs that help us to express our view. And we're trying to find things that are good getting better, where we can see improving fundamental characteristics in the securities and prices behaving the way they should if in fact things are getting better. So strong fundamentals and strong technicals, and if we put the two pieces together, that's where our portfolio should live. And then the most important thing is to be really disciplined at inventory management and carving out the positions that aren't working the way that we would expect. So when we see deterioration in breadth, like we did over the last 6 weeks, we should tighten up our stop losses. We don't put any new positions on. And if we have cash in the portfolios, we hold it and wait to see things start to improve. So it's all about managing risk. Raise some cash, tighten up stop losses, and we wait. So as we sit today, we have a lot of red on the screen. Now, just because we have weakness in the indicators in the short run doesn't mean that it's going to go on a long time, but we respect it. You can't have a long-term sell-off before starting with a short-term correction. If we look at breadth globally, whether we're looking at Canada or the US or globally, breadth has been weakening over the last 6 weeks. The percent of stocks in trading above their 50-day in general has been weakening. Percent of stocks with weekly momentum has been weakening, and the percent of stocks with the 150-day moving average has been weakening. So what does that mean? It may mean that the broader market is correcting. It may mean certain parts of the market are correcting. It may mean it's going to get worse. Our job is to manage position by position. So things that we're watching. In the US, the percent of companies trading above their long-term moving average has declined to 55%. And you can see that that happened sort of from the back half of November through until now. If you look at the percent of stocks trading above their 50-day moving average, we went from 80% of companies trading above their 50-day moving average to 17. Now look backwards. In the most recent pullbacks in the market, this bottomed at around 15%. So that's something that we're watching. Maybe it is that we're getting close to the end of this little pullback, but we won't see it until we see it. When we look at the number of stocks hitting new lows, interestingly, in the backing off in December, 70% of stocks made a 20-day low or a low price in the previous 20 days. Actually, while we've been going through more correction right now, only 34% of stocks are making a 20-day low. What does that mean? It means fewer companies are behaving poorly. So that's something we're watching. That's something getting a little bit better. And the other thing we like to watch is sentiment. When private investors get nervous, they go and buy puts in the option market. That's the right to sell a stock at a certain price. And we know when you're getting later in a correction, we can get a big spike in the number of people buying puts. So we had one in December of 22. We had one in September of 23. We had numerous small spikes through 2024, but we know we had very little by way of correction. And as we've come into January, we've seen put buying in the 99th percentile, like we did back at the lows in 23 and like we had in the lows in 22. So it could be that we're getting toward the later stages of this little pullback, something that we're watching. Sentiment certainly is starting to get a little bit washed out. So in mid-December, we looked at breadth getting a little weaker, and then we said last week that breadth had continued to weaken. If we look at it as of this week, we take all of the sectors. This is as of today. The average sector has 35% of stocks in uptrends, where it was 39% a week ago. So 5% of stocks, 4% of stocks by sector have weakened. When we look at a distribution curve, down here are the strongest sectors. At the far left are the weakest sectors. So we know not everything is being hit the same way. Some things are doing a little better. Some things are doing a little worse. So we're going to look at that when we walk our way through leadership. So let's do that. Okay, so biggest sector we've been focused on has been financials over the last 2 years. Pulled back a little bit in the month of December, a little bit in the beginning of month of January. Clearly in a long-term uptrend. If we look at the percent of stocks trading above their 50-day, it has come down to sort of washed out levels in this little pullback on the short-term basis. So that's kind of encouraging. When we look at the opportunity, we've talked about the fact that we think that financials will be a big beneficiary of deregulation. We know that there was tons of regulation in the Biden administration. There was tons of regulation in the Obama administration. There's lots of room to cut regulation. So what's happening in the leading stocks? So our largest bank position has been for the last 3 years, JP Morgan. And JP Morgan did pull back in the month of December. But look what's happening in January. It's marching higher. In fact, it's just off all-time highs. If we look on a relative basis, this blue line below, if it's sloping higher, it means that it's outperforming the S&P. In fact, if it's making a new high, it's making a new high relative to the rest of the market. So JP Morgan, as the most important bank in the world, is making a new relative high versus the stock market. That tells you something. If you're making a new relative high versus the market, that's a leadership security. Goldman Sachs, trading better than 90% of all the companies in the market over the last 365 days. And while the market has made a lower low recently, it's made a higher low and tipped back higher, up 2% today. Fairfax, our biggest holding as a firm. Large property and casualty company, relative strength has been very, very dynamic. And yes, pulled back a tiny bit, but bounced sharply today, and relative strength is trading just below the lows. So that's very encouraging, right? Our largest sector weight is financials, and financials continue to relatively perform well versus the market. We talked about in last fall that exposure to financials in portfolios, institutional portfolios in the US, is still very, very low. And when we look at what's happened over the last 3 months, there's a little pickup in the amount of financial services companies held in institutional portfolios, but it's still well below the long-term average. So it's not crowded, meaning everybody doesn't own these things already. In general, they are under-owned in institutional portfolios. Outperformance plus under-ownership means that there could be appetite to continue to add. And certainly if we see some deregulation, making things a little bit more efficient, we think this is a theme that could continue on for a long time. Industrials. Industrial services companies are a big beneficiary of one of the big themes that we think is going to continue to take place, and that's reshoring of manufacturing. If we look at the equally weighted basket of industrials trading above the 50-day moving average, trading above the 21-day moving average, way above 200-day moving average, and continuing to be in a series of higher highs and higher lows. Industrials relative to the S&P 500, this is that line I was talking about a couple of charts ago, steadily rising and in a long-term uptrend. So this has been a leading group since midway through 2022. In fact, it started to outperform the market in June, and the market bottomed in October. That was an early sign of this leadership. It's what got us here, and lots of companies performing well. If we compare the equally weighted basket of industrials versus the equally weighted basket in the S&P, since 2022, it's been outperforming. We think, again, this is relatively early days, and we will look at small cap or smaller companies in the industrial space. They're actually making new relative highs versus the small cap index. And that probably is to do with the fact that these are largely industrial, domestic companies that would be beneficiaries in the event that there were tariffs. So there's always things to worry about. Our job is to figure out how to make lemons into lemonade, and our job is to find companies that will benefit under the current policies. So if we think that there's going to be a lot of natural gas power production to fuel the power for data centers, then the company that makes turbines that work in a natural gas power plant should be a winner. And we've talked about this over the last several weeks. Look at the performance out of GE Vernova, up 5.3% today. So rocketing to a new high. If we look at Howmet Aerospace, which makes fan blades for fighter jets and commercial jets, making new relative strength highs today. Remember what we said at the beginning of the call today. When you go through a correcting period, you want to look at the things that buck the trend, because everybody gets worried in a correction. But if investors have significant conviction and show willingness to buy against the grain, it generally means as the market gets better, these securities will continue to lead. So seeing really good performance out of, in particular, our industrial holdings, and industrials in general performing well relative to the market. Materials. Now, materials did correct in the month of December, but this week we've had a significant pop in the performance level. Metals and miners are a group that corrected. You can see that in the month of December within the long-term upward trend, but certainly pulled back. We look at the companies that we own. Agnico Eagle made a new relative high in the last 3 days and trading very close to 52-week highs. We really like this company. It pays us a nice dividend. The dividend growth over the last 5 years is 26% a year. They don't need capital. They generate cash. And this is a company that we think will continue to generate cash as gold prices go higher. They're a solid operator. We think they continue to perform well. Cameco, we talked about, pulled back a little bit over the last couple of months. But again, to put it in context, it's been through a bear market that went on between 2007 and 2023. The last bull market brought a return of 2,250%. We think it's very early days and that this can go on for a while. Energy. Now, interesting, energy is something that we've talked about over the last month as a sector that is starting to wake up. And we talked a little bit last week about, what's going on in this group. It's the only sector where the equally weighted index, in other words, take all the companies in the sector and give them each a single vote. It's outperforming the largest companies. That means a broad-based strength in the sector. When we look at the percent of stocks making 20-day lows, remember, we've been correcting. 0% of securities are making 20-day lows. That means the sector is outperforming. While the market's been pulling back, energy stocks have been rallying. That's a second thing that's important. When we look at relative performance versus the market, after this period of correction through 24, seasonally on cue, where seasonally you get a low in December, it started now to outperform the stock market. So this is the only group that we added to in early December. And particularly, we focused on the natural gas producers. So we've seen a nice turn in the price of natural gas. That's important because natural gas is seen as one of the ways we are going to produce enough power to supply all these data centers that we talked about last week. Significant data center growth going on, and a lot of that will be powered by natural gas. So we talked about ARC Resources last week. Look at the relative outperformance versus the market, making new relative highs this week. No weakness versus a weak stock market. Cheniere Energy, we talked about last week. This is the company that sells liquefied natural gas overseas. Well, this was last week. This was this week, up 5.4% today in a market that basically was up, 30 basis points, 0.3 of 1%. That's exactly what a leading stock should do. So relative outperformance. We spent a lot of time watching this line. We want to make sure that we continue to be in a relative uptrend. And this is a great sign of strength, especially in a market that's been sloppy. Enbridge. These are the companies that are pipelining the natural gas and oil. Great relative performance, better than 80% of companies over the last 365 days. And if you look at the ETF that owns a basket of energy infrastructure companies, AMLP ETF, up 2.6% today, again making new relative highs. So energy looking awfully strong. And this is a theme that we think is going to be an important one this year. But look at the exposure. If we look across prime brokers, this is prime brokers who hold assets on behalf of fund managers. This is the current exposure relative to history. It's as underowned as it has been in the last 5 years. Strong performance, underowned, that gives us good risk reward. What is well owned is sustainable power, wind and solar, and still no sign of a bottom here. Certainly, I don't think the new administration is overly friendly to alternative energy. Consumer discretionary had a great fall. It's corrected, of course, over the past 6 weeks or so. We're trading basically at the 50-day moving average. We don't have tons of exposure here. Dollarama has corrected with the group, trading above long-term moving average, better than 70% of stocks in the market. Amazon actually has hung in really, really well, basically sideways versus the market over the last 2 months. We think they're great executors, nothing to be worried about there. Communication services, correcting a little bit. Still the sector better than 83% of companies in the S&P. We've been really focused in companies like Meta, which would be a beneficiary of changes at TikTok, and relative strength continues to be quite strong here. Technology, we've been underweight now, I don't know, 7 or 8 months. I think that we're about a third of the market weight. It has continued to kind of relatively underperform. In the last couple of weeks, some of the large cap tech stocks have been selling off. We've been a little bit concerned about that. Cybersecurity has been about the strongest area, good relative strength, and semiconductors have been about one of the worst areas. So we've been very careful here. The only thing we own is NVIDIA. It's behaved very, very differently in the sector. But you can see, put in a high in July. And since then, we've had quite a choppy trading period for the basket of semiconductor producers, which of course includes NVIDIA, but NVIDIA has been a real outperformer. This is one that we continue to watch. I really would not like to see this sector break below this blue line. That would be breaking long-term trend. So that's something that I'm watching. In fairness, we are short the semiconductor sector in one of our strategies. Other sectors that would be seen as more defensive, no sign of strength. Utilities kind of underperforming. Real estate investment trusts certainly underperforming. Consumer staples companies. I think one of the reasons consumer staples are underperforming is that the GLP weight loss drugs really call into question consumer packaged goods companies' ability to sell high margin, sort of manufactured food. And certainly the market is a little bit cautious about that as well. But these are all sectors that we would expect to see do well if you thought the economy was in trouble. Now we're about to go into the earnings period. We'll start to get financial services companies reporting this week. Coming into the period, there has been, in some areas, some pullback in earnings estimates. And if you thought the economy was weakening, you would expect these to relatively outperform, and they're just not. So defensive sectors, or things that act like bonds, like the housing stocks, they get hurt by high interest rates, are underperforming. So we're watching this closely. Just to take away, and I talked briefly about it last week, if rates are going higher, mortgage costs are going higher. If bond market is selling off and bond prices are going down and yields are going up, the cost of a mortgage is going up. And so I keep in mind that when rates started to rise in 1950, and they continued to rise until the 1980s, real home prices relative to inflation went nowhere for 30 years. Now that's a really different experience than what we've lived through over the last decade. So we want to keep that in mind. This is an asset that gets hurt by higher rates, and you don't have to look further than the number of mortgage applications that are being put in relative to history. They really have come down. So appetite for housing and new homes and resales may be waning. We want to be cautious here. Healthcare, a little bit better over the last couple of weeks, but still generally a relative underperformer. And low vol, this is low volatility securities or defensives. Again, no real bid here. So putting it together, there's some things to take away. First of all, I do think it's interesting that if we compare semiconductor companies to energy companies, after outperforming from September of 22 through until about June of this year, they're now underperforming energy. And historically, when you get a rollover in that trend, it can go on for a while. So happy to be underweight tech, happy to have a more significant weight in energy. If we look at our themes, the bank and financials theme looks healthy. Power production and natural gas looks healthy. Reshoring of manufacturing looks healthy. And so far, the AI theme we think is still relatively early days, and in particular, the leaders look healthy. From a firm perspective, financials continue to be our biggest weight. You can see it is slightly smaller than where it was a month ago. And we said, we've taken a little bit of money off the table to have a little bit of cash. 6% in cash and roughly 6% in T-bills. And if we were to scrounge around, it's probably 15% cash by account, which is not a lot, but it gives us flexibility in the event that market continues to be sloppy over the next little while, gives us some dry powder that we can use when it comes time to put money to work. When we look at the bond market, we do have some corporate bonds, about 8% of firm assets. That's largely in our balanced mandates that have to own bonds, and those in general are 2 to 3 years in length, and they're corporate issued, not government issued. From a sector perspective, energy is our third biggest weight, and it's a significant overweight versus the market. Industrials are an overweight, although we did get stopped out of a couple of positions over the last month. Technology has continued to be about a third of the market weight. When we look at the defensive sectors, healthcare, real estate, utilities, consumer staples, still relatively small part of the portfolio. And while our materials weight went down a little bit in the month of December, it's still double the weight of the market. So no major changes, just a bit more cash. If I look at the year last year, the equity portfolio is up about 20%, the income portfolio 21%, our global equity portfolio up 27%, and our balanced account, which has to own fixed income, up just under 14%. The equally weighted S&P was up 12.7%, the aggregate bond index up a little over 1%. I'm pretty happy ultimately with how the portfolios came through. We have to keep a couple things in mind. The number one thing that impacts asset prices is liquidity. And the central banks are now working at providing liquidity. We are in a rate cutting cycle, and that is in general supportive of asset prices. If we look at the risk that's perceived by bond investors to own either investment grade or high yield bonds, the premium they're demanding to own those versus government bonds is going down and looks nothing like where you have a problem like 2020 or 2016 or 2011 or 2008. This looks very unlike this. When we look at high yield, how it's doing, high yield bonds are higher risk bonds versus investment grade bonds are outperforming. The market is risk accepting. And when we look at volatility, it's solidly within the range that would be typical in a cyclical bull market. So when I see weakness in breadth with all of these other indicators positive, it tells me likely we're just got a little indigestion. The market's doing a little bit of beginning of the year positioning. We see no significant changes in our major themes. So we believe that we have room to move over the next couple of years for equities and room to move over the next couple of years for commodities. Look, bull markets tend to last a long time. If this one was over after 2 years, it would be awfully short relative to history. If things get more difficult, we'll get more defensive. But as it stands right now, with some cash in the portfolios and our theme's performing well, we're pretty comfortable with how things are set up. With that, let's check and see if we got any questions. We got lots of folks on the line today. Let's see what we've got. Okay, so let's see what the questions are. Alejandro, do you think the debt service in U.S. is a factor we have to watch as a potential catalyst for a major correction in the market 2025? So, look, to be clear, the consumer in the U.S. doesn't have tons of debt. After the financial crisis 2008-9, U.S. investors worked hard at paying down debt. Canadian investors and Canadian individuals do have a fair bit of debt. U.S. corporations don't have a ton of debt, and they do generate a lot of cash. The area that we would be concerned about is government-issued debt, and we know that deficits around the world are very high. In the U.S., the deficit is ballooning quickly. We'll see whether the Trump administration can do anything to head that off at the pass. We do think that it is having an impact on demand for U.S. government treasuries, and that's part of the reason why yields are moving higher. If you look at the historical buyer, Chinese are buying gold. They're not buying treasuries, and other countries are doing the same. There is some consideration that some countries may be buying Bitcoin as an asset, as an alternative to a treasury bond. And certainly, while I don't think it's anytime soon, there is a group of countries in the BRIC countries that are looking at trying to find alternative ways to settle export transactions using a common currency. So we'll see what happens there. But I do think that in general, there's a lot of factors conspiring against the bond market, which makes it less attractive for us. If yields were to back up very quickly, that could have a negative impact on the stock market because it would be a fast-moving part that people would be confused about. But as it is right now, the move higher in yields has not been overly fast and has not been enough to shake the confidence of the market yet. Jerry, what do you make of the price of WTI up significantly over the last few days? What's the reason? Well, there certainly is more conversation around additional embargoes on energy, and we think that there's likely to be more disruption in global energy markets because of geopolitical upheaval. So that's something it is in the way right now. The Canadian exploration and production companies, depending on who they are, the gas stocks are performing well, but not as strong as U.S. gas stocks. I think that there is some overhang of concern about whether, in fact, the Canadian energy patch will face tariffs. The large oil sands companies, I think, are less likely to be impacted by tariffs because, frankly, you can't run U.S. refineries without our Canadian heavy oil in the mix. But I think that is an overhang. People are concerned about that. Ultimately, Canadian energy and exploration and production companies should do better if we're going to have a change in government. And ultimately, if the economy is strong, energy should perform just fine. We got a question on Molson Coors. I have to be honest, it's something I haven't looked at recently, so I think I can look at that. And if you'd like to have a direct conversation, happy to talk about it. And the last thing is a factor that we have to watch as a potential catalyst for major correction in the market. Oh, what is a factor? Sorry. Oh, debt service. No, we answered that one already. I think that's it. So we're not posting a lot on Twitter over the last couple of weeks because there's not a lot new that we're doing. But don't hesitate to follow us at Barometer CA is the Twitter handle, and we'll be back next Tuesday with an update. If you'd like to have a conversation in the meantime, I know we're working through reviews with clients currently. I know that Tiffany and Shavana are busy actively building out new plans for clients. And if you'd like to have a conversation, please reach out. Happy to set one up. Everybody have a great week. We'll see you next week.